Good day and welcome to the Kona Perspective Asset Market Review for the 6 months ending 30th of June 2025, as well as a little bit of some more up-to-date commentary through July and to early August. Lots of slides, so we're not going to dwell on too many of them. If you've got any questions or comments, you're most welcome to reach out. Right, starting with currencies, and they really frame quite a lot. There's been a lot happening in currency markets, as you'll see in a second. I think the central theme there has been one of dollar weakness. We'll look at some of those numbers in a second. And that's important because obviously it creates the illusion sometimes of certain currencies like the Rand doing relatively well. But when you look at it against some of the other crosses, it's a little less convincing. And also, of course, it's important to remember that when you're measuring in dollars, obviously your non-US holdings are flattering those returns slightly. Okay, so looking at the currencies, a lot going on in the table. You can see the Rand against the dollar. As I was saying, it's been strong. You can see in that table at the top there, Rand to the dollar on a 1-year view, firmer by about 3%, but a little less convincing against the pound and the euro. We're down about 4% against the pound and around 6% against the euro, remembering that there are virtually no inflation differentials, or there are no inflation differentials, so that is, outright weakening. And there you can see the second last column on the right-hand side and the last column showing the dollar having lost up until the end of June around 7% against the pound and around 8% against the euro. More recently, given back a little bit more than that. You can see 3-month view, quite similar performances. If you look at 6 months, obviously the dollar's lost even more ground, and the Rand is a little bit better. So a little bit noisy, but is relevant and worth remembering. Okay, moving swiftly into equities, obviously the most important of the asset buckets. Looking at the more recent performances of world indices to the 30th of June. I'm not going to dwell on the South African ones because we'll deal with those in more detail later. If you look at S&P on a 1-year view, up 19%, the Nasdaq 27%. We'll unpack some of those performances in a second. But you can see the Russell quite disappointing. Over a 1-year view, only up 6.5%, very much in line with what the stocks has done and the CAC Caron. FTSE's finally starting to look a little bit better. But as you'll see in a second, the Xetra DAX done very, very well. And then Hang Seng looks spectacular on a 1-year view, up 45%. But as we'll see in a second, that's really just low base effects in large part. I think really the standout performance, if we look over a 1-year view, very much the DAX. And markets have been very volatile over the last sort of 3 months or so, ever since Liberation Day. Obviously now, capturing some of the base effects before that. But from those lows of April, obviously markets have recovered quite significantly. Right, and clearly the 1-year winner is very much the Xetra DAX. You can see on a 1-year view it's done spectacularly well. But I thought it would be worthwhile from a context point of view just to illustrate what the longer term performances look like. And you can see going back 10 years, for around 7-8 years, the DAX really was going nowhere in a hurry. And really, beginning of 2024, it really kicked into gear. You can see there some of the DAX constituents. Many of them have done very well, the likes of SAP and Siemens, but obviously defense maker Rheinmetall has also helped to power that index firmer. But I think the key point here, 1-year performance or 18-month performance looks really good. But a little bit longer term, actually not that spectacular because it drifted sideways for so long. Then looking a little bit longer term, which is always useful. If you look, for example, the Nasdaq over a 5-year view, it's up 116%, so more than doubled. You can see there that's taken the S&P 500 with it, and we'll look at index composition in a second to try and frame that. You can see the Dow, a lot less convincing, up 58%, and the Russell only up 40%. And as you'll see in a second, if you were to strip the Mag 7 out, particularly those high-flying Magnificent 7 and some of the other technology, darlings, the broader S&P 500 actually not performing very differently to the Russell over a 5-year view. Then the FTSE 100 up 50%. That's compounded roughly about 10% a year. Not bad. Generally, dividend yields there probably better than you're getting in other parts of the world. Very similar to what the CAC has done. You can see the DAX off that low base, up 86%. And then China being very disappointing on a 5-year view, still down 11%. And finally, the Hang Seng is flat. So in spite of that 48 or whatever percent it was, rally in the 1 year to June for the Hang Seng, longer term performance is not looking great. And there you can see on the right hand side the PE multiples. South African equities sitting around 12 times, both historic and forward is a little bit lower than that. And you can see the likes of the Nasdaq on 35. So you could almost fit three South African multiples into the Nasdaq, which is quite a scary number. You can see European equities after the rally, up in the late teens. Forwards are a little bit lower than that, and then Hong Kong and China still looking better. So quite a messy performance, if you have to be honest, regardless of whether you're talking 1 year, 3 year, or 5 year, with a few performance detractors and a couple of stars. But clearly, the standout winners have been the technology shares. As you can see there on the top, which is the Nasdaq, really has been the powerhouse, shaking the S&P 500 with it. But if you look at the bottom there, the Russell 2000, a lot less convincing, really just in large part drifting over the year. Looking at the US longer term, particularly at the technology sector, you can see over 5 year, Nasdaq has had its bumpy rides, but generally very, very strong from the lows that we saw in April. And obviously, if you look longer term, doing very, very nicely as well. Always useful to try and frame what has been driving the Mag 7 and the Nasdaq. It's a very, very interesting chart, courtesy of FactSet. And really what we're trying to illustrate here is if you take the quarter-on-quarter earnings, the red bar effectively is the Mag 7 income growth. The black bar is the rest of the S&P 500, and then the gray bar is the S&P 500 in total. And if you look at the little black bars, you'll see that in large part, average earnings growth over the last few quarters actually been quite disappointing. Occasionally early double digits, but quite often less than that. Whereas you've seen, for example, if you look at Q4 2023, some 60% earnings growth out of the Mag 7, and that obviously was powering S&P 500 earnings, but also kind of justified those ratings. But as you can see there, that red bar definitely trending down, where you can see the sort of the outperformance in terms of earnings growth that we've seen out of the Mag 7 definitely starting to dissipate. And some analysts are of the view, and I tend to agree with that, that over the next year or two you'll probably see the Mag 7 income growth relative to the S&P almost completely evaporate, obviously depending on what the S&P X them do. So that quite interesting, just sort of explains the performance, in a way I suppose justifies the performance. And then also quite interestingly, this is a very busy chart, I apologize, but as you can see, I think the really important piece is on the left hand side, the green line is basically the performance of the Mag 7 indexed to 100 in 2021. And if you look, for example, at the black bar, which is the S&P 500, and then the blue line being the S&P 500 X the Mag 7, you can see that almost all the Nasdaq performance has really come from those 7 counters. Also, quite interestingly, and it's something that's actually been concerning us for a while, and I suppose it's because of our context of having seen such heavy concentrations in the JSE over time. If you look at the S&P 500, the top 10 shares there, which is actually the top nine because you've got double counting on Alphabet. Never before have you seen the concentration in the top 10 as big as it is right now at around 33%. And although you've got Berkshire Hathaway in there, the reality of it is this sector is really dominated by new economy stocks. And, we're not sure how long that type of trend continues, but definitely we've seen through analysis just how volatile the underlying S&P 500 top 10 constituents can be. And there's a very high probability that quite a few of those that are big heavyweights today won't be there and will make way for new companies into the future, whatever sectors they may come from. And then you can also see how the S&P 500 is dominating the geographic. Just the era of exceptionalism out of the US and the strong performance of those top 10 has really resulted in the US in terms of the MSCI index geographic composition representing well over 70%. And you can see information technology a very, very big weighting, as are consumer discretionary, for example, which is where companies like Amazon come in. So a very concentrated index at the moment, and quite a few commentators, ourselves included, are of the view that there's just too much concentration in those top nine shares. Right, then moving on to the local equity bucket. Also, for context, always useful to show the top 40. And what I've done in the bottom right is illustrated the top 10 of the top 40 index going back to 2021. So, that gives you a 4-year history. And as you can see, Naspers, BHP, Richemont, and Anglo has represented over 50% of that index. Quite interestingly, neither BHP nor Richemont are actually in the top 10 anymore. New entrants there are the gold stocks, which we'll discuss in some detail now, but Gold Fields, Anglo Gold, and obviously the likes of Capitec have found their way in there, as have British American Tobacco. The other important standout is, the significant de-weighting of Anglos, from call it 10% down to 2.75. So I think the bottom line is the JSE, as we all know, particularly the top 40 and the SWIX, tends to be very, very volatile in index composition. And if you're tracking, you would argue that's a good thing. But, for more sensible investors, it does mean that your benchmark tends to change very, very rapidly and quite aggressively. Looking at the more recent performance of the JSE indices and sub-indices, you'll see there on the 1-year view, which is really the most important number, we think. You can see the Resi 20 powered by gold, and then technology also a strong performer. We'll discuss telecoms with their 77% in a minute, but remembering that that's a relatively small weighting. As you saw now, gold and technology in the form of Naspers and Prosus are very significant weighting. So in large part, gold and technology accounted for almost all the performances, and as you can see, performances from some of the other more locally oriented indices like FINI and banks and even consumer, a lot more pedestrian than the 24. So it really has been a very, very polarized performance from the JSE over the last 6 months. And bottom line is, if you are not at weight, which we'll see as we saw earlier, at around 15% in Naspers and Prosus, adding to that, if you're not almost excessively overweight Naspers and exposed to golds, it was really quite difficult to get performance. And then if you look more recently, you'll see quite a mixed performance as well on the 3-month view. But bottom line is JSE, very, very mixed bag of results. Basic materials and resources really being powered by gold and more recently platinum. Just maybe looking at the stars, you can see there the top index, the PMM, is the precious metals and mining. It's quite strange that the gold index was no longer supported. We've now got that precious metals index, and as you can see, had a very, very good run up to over a year. And then, interestingly enough, more recently in the last month or so, as we'll see in a second from the performance of the platinum and group metals, strong continuation in that theme. But really, over the last year, much of that performance coming from gold shares. And then you can see the technology sector at the bottom, also done very, very nicely, with spectacular performance out of effectively it's only Naspers and Prosus in that index. Then some of the less impressive performances come from, let's call them what they are, the local economy stocks. As you can see there, the consumer stocks, the banks, and the local industrials, all looking dull. The weakest performance of all coming from the industrial counters. And it's quite strange to think that companies like Bidvest actually down 8 or 10% on a one-year view as we speak. So it really has been a very difficult market to actually generate any performance if you were not very concentrated in a handful of shares. The precious metals index, as we said, powered in large part by gold. I've taken a longer-term gold chart there. You can see going back to 2021 to illustrate that for a very long time, maybe four or so years of the last 5.5 years, gold really just trending sideways, but obviously more recently really kicking into gear. Difficult to say exactly what was driving it. I think it's probably a combination of some real demand, but also fear around inflation and people looking for alternative currencies to, for example, the dollar. And then at the bottom there, you can see the platinum price, which also has ratcheted up from, a very, very sort of disappointing level over the last 5 years, suddenly sort of broke out of that very tight trading band of sort of, let's call it $900 to $1,000 an ounce, suddenly popping to $1,450. Probably helped a little bit by lease rates, but also we believe some supply demand issues. So we think that the precious metals and mining index may very well over the next 6 months be more driven by platinum shares and platinum derivatives than outright gold shares. Then looking at the longer term performance of the top of the JSE, you can see their top 40 and the all share up 70%. Interestingly, over a 5-year view, because of the low base effects of COVID, you can see banks up 149%. We'll look at that in a second. You can see still local industrials, very disappointing, 34%. And then telecoms, once again, up 89%. We'll unpack that a little bit more. And then obviously, as we've always said, small cap index in South Africa is actually not very representative of that massive cohort. But anyway, and then obviously technology on a 3-year view done spectacularly well. But the base obviously from 5 years ago weighing slightly on Naspers and Prosus. Looking a little bit more at the performance, banks and telecoms long term, as we say, really haven't done very much. So that's a 10-year chart at the top of the JSE banking index, and you can see, for some 7 years really did nothing. But obviously, just because we're measuring it now from almost the low point, courtesy of COVID in middle 2020, looks like a spectacular recovery, but maybe not quite as convincing as that. And then equally, if you look 10-year chart at the telecom sector, which is obviously MTN's the big heavyweight there, but Vodacom and Telkom as well, you can see that Telkom's index is still down over a 10-year view. So, sometimes period performance can be. Right, then quickly moving on to bonds. The bond market has been interesting, to say the least, over the last 5 or so years. If you look at global bonds, we've had this conversation before, global bonds appear to be normalizing, with pretty much the the US and the UK 10-year around the 4.5 mark. Obviously, Germany always trades at a yield discount to them. And then Japan is just the oddity, as we discussed in the big picture. If you look at what inflation is doing and where bond yields are, there really is a disconnect. But so although if you look over a 5-year view, it looks as though bond yields have ratcheted up significantly, they're really just in line with their long-run averages. Then, we were quite vocal on the risks in the global bond market. When interest rates were ridiculously low and you saw yields negative in many shorter dated government debt, from sort of 2020 to fairly recently. The net effect of that, as you can see in the top, is if you had come into US Treasuries over the last 5 or 10 years, you would quite possibly have lost money. You can see the table at the underneath that top graph, pretty poor performance. And if you go a little bit further out, look at the world, obviously again measured in dollars, which is arguably a little bit artificial because a lot of this is more around the US dollar weakness. But as you can see there, even though those returns are positive, they are sub 1%. So global bonds, you have to be honest, over the last 5 or 10 years have been very, very disappointing. But it was frankly to be expected with yields as low as they were and a high probability that they were going to normalize. If you look at South African bonds, we feel South African bonds, we've had the view for some time that they looked attractively priced, particularly in the mid end of the curve. You can see the 10-year there at 9.6 odd percent come down over the last few months from just about 10. And from when we had that wobble a little while ago, particularly around the budget, we've seen a nice recovery. On the right-hand side, you can see the yield curve. The purple dotted line is effectively where the yield curve was about a year ago, and you can see almost across the board it's ratcheted lower, with the exception on the mid-end around the 5 to 10-year mark, but generally yields looking a lot better, and that yield curve actually not very steep at all, in fact virtually flat from around the 10-year mark. So bonds were a good place to be. You can see this is just the Satrix Govie, which is really just gives you an idea of the price performance. As you can see from an index of a level around 725 to almost 9 being invested in South African government bonds actually generated quite nice capital gains, and arguably the downside was quite limited, say 5 years ago. Then listed property, again, I've got the long-term chart, let's call it almost 20-year chart. You can see that index has done virtually nothing. Obviously, over the last few years, it's looking a lot better, but still from the highs that we saw before the COVID sell-off, it's really at around half the level. So we remain fairly neutral in terms of mindset towards listed property. We continue to favor government bonds, and when we get to the commentary on the flexible fund, you'll see that we continue to hold no listed property. It's hurt a little bit of late, but we opted rather to hold bonds and some inflation-linked bonds. Global property, very similar sort of story, although the recovery is probably a little bit more significant. You can see here over the last 5 years, listed property globally has really not done awfully much. Although it's well off its lows of 2021, still hardly driving the needle very, very much. So in summary, obviously it's a very difficult time in asset markets, whether you look at South Africa, where the performance has really come from a handful of shares, or internationally, where arguably it's really been a case of you buy the S&P and nothing else, and you hoped and prayed that the Mag 7 would continue to deliver. You get the feeling that play has changed. We think that it's a time to be very circumspect with very high valuations, particularly the Mag 7. as we showed, the earnings growth rates are definitely going to start moderating in the Mag 7 and some of the more highly valued companies. We've seen a brutal US result season. Even companies who delivered really good results, but who may be guided for a slightly different or difficult outlook, have been absolutely punished. You've often seen companies with just the mildest bad news or commentary losing 10, 15, sometimes 20%. So it's really a brutal time to be in anything that's likely to surprise, particularly if it's on a high valuation. We believe that generally the lower growth scenario in the US and Europe will probably result in slightly lower EPS growth rates. We'll see how corporates in America, for example, react to tariffs and how much they're going to absorb in terms of margin sacrifice. So that'll be quite an interesting play over the next year. We believe that local dividends look very, very attractive, not just in the big banks, but quite a few companies, some of the asset managers also looking very, very attractive from a dividend yield point of view. And generally, we would say, as we normally would, being slightly more conservative and value oriented, we continue to favor lower multiples and slightly more defensive business models. We have no problem targeting companies that generate reasonable earnings growth as long as it is relatively predictable, and would still generally be very, very mindful of the price that we pay for the growth. So we think that markets are busy shifting gears. We think that the next 6 months is going to look very different to the first 6 months. And generally, I think probably quite a good time to have cash. In closing, we thank you for your time and your attention. And as always, we welcome your input and guidance and interaction.